develop. This is GBP-CHF now. GBP-CHF presented a little shift candle, a little D1 here off the 50. I'll show you that in a second on the 1 minute. And that shift really set the tone for the day. See how the 8 and 21 EMAs cross up there? They shift up, and now it's held that 8 above the 21. As this continues to develop, it most likely will head back towards this ADR level at about 60 pips. Now, a 60 pip ADR on GBP-CHF, in my opinion, in my experience, is very low. It's a very small ADR. Normally, these GBP pairs have a lot of volume in them, but they've some of them have cut back a little bit in the last couple of weeks. So now as this gets closer to that ADR level, it's going to be harder to find really good risk reward. Because let's say, for example, we weren't in this trade earlier from last night. Let's say you're looking to go long right here. If you were looking to go long here, your ADR level is 16 pips from where price currently is. So if you were talking about reading risk reward, this is the biggest thing to remember. On an average day, which we want to assume every day is average, you never know if it's going to break like Euro USD did and run through its average daily range. You never know when that's going to happen. So we assume it's going to be an average day. So if we can't get 2 to 1 for ASFX entries on the ADR level, then it's never going to be a trade that I take, because what you would be saying with your trade is that you're forecasting it to be an above average day, and that just doesn't forecasting doesn't work consistently. So instead, with a 16 pip distance from current price to average daily range, if you had to put a 16 pip stop in, what's your risk reward? 1 to 1. So that's not going to make sense for me. Now, if we've got 50 pips left on average daily range, and our risk for the setup in question would only be maybe 10 pips or 15 pips, 10 pip stop loss, 50 pip potential move to ADR, 5 to 1, that's a trade that I'm going to potentially be in if it fits everything else for the trigger signal. But it's really important to focus on risk reward. And using average daily range can help save you a ton of money, because you won't get caught up in a pair that's already made its move for the day. And then you're just sitting there as it chops sideways in a tight little range because the pair already did what it does based on the last 5 or 10 days, whatever average you're using. I like to use a 5-day. And that just is logical to me. We're not forecasting, we're reacting based on what this pair has done over the last X amount of days, 5 days for me. That's why ADR is so important. So that's GBP-CHF. The only other pair on my watch list right now is USD-CHF. I don't love this pair in general. I'm not a big CHF guy. I'm not a big Swiss franc guy. But market sentiment today is bullish, very bullish. And Friday, this moved higher as Euro USD moved lower, right? We saw the USD base pairs all move up on the news. USD quote pairs moved lower. Here, what I don't love about this is how high the market sentiment line was over the 70 value to start the day. That is overbought to me. Anything over 70 is overbought. And I don't have a lot of testing for trading market sentiment lines that look like this. I have a much better gauge and a much better read of trend when I'm trading something like this. Look at the market sentiment line here. Not overbought. In one zone all day. It's perfect. That's the market sentiment lines that I'm looking to trade, because that trend will ride for days and I just need to find my entry triggers. That's it. It's already giving me the bias. I don't have to overthink it. I don't have to overanalyze it. There's no potential for that. But this one on USD-CHF, if you took a trade here and it ends up coming down today, you'd be like, why did I take the trade when market sentiment was so overbought today? You know? So that's just me knowing what I know and knowing what I don't know and staying away from what I don't know. Make sense? So that was my watch list this morning. Nothing on GBP NZD today because this already maxed out its average daily range. It's only 100 pips on the ADR here, which is low for GBP NZD. But EMAs are very tight, choppy together. Market sentiment line is swapping, and it's, like I said, maxed out its average daily range. Those 3 things right there, if you just know how to identify those 3 things, you'll never get caught in choppy trades, ever. These EMAs are not in trend, this market sentiment line is not in trend, and it's maxed out its average daily range. Again, knowing how to identify those 3 things will improve your trading by reducing your losses. Guaranteed. And if you don't know how to do that, that's what we teach in the course. That's what we teach at ASFX. So I can send you a link for that in a second. But let me keep going just to get through the list. GBP USD looked a little bit better than GBP NZD. However, EMAs could be better. Your 200 EMA is above your 800 EMA. That's not in full trend. It'd be better if the 200 was under the 800. Also, you've got this bullish divergence here building on the bottom. It's bullish because the RSI is rising from Friday's low. Price action is already respecting that line twice. So it's a pretty strong divergence line. Now, if the market sentiment line was not up in the buy zone right now, above the 50 line, then we could potentially look for this to come lower. It would make a little bit more sense. But just like we saw on the other pairs this morning, market sentiment has now pulled up into the buy zone, right? And you're in an upshift. 8 EMA is above the red 21. So let it shift down. Let it show you that it still wants to move lower today, because what it's really saying, if you look, it's making higher highs. It's also making lower lows if you look at this low, but also higher highs. So it's indecisive. It's not in full trend. Turn away from it. That's all you have to do. You don't have to try to be like, how do I find the entry? How do I figure this out? No, don't overcomplicate it. Like, if it's not readable, move on. That's how I always have made this like really easy for myself. I used to not. I used to try to force trades on pairs that I just wanted to trade. Another great example here on GBP JPY. Look at the market sentiment line. It starts the day above 50, drops down below 50. So it's swapping. That's the first thing. Look at price action. Price action is making lower highs from the start of the day, start of the week, lower highs and lower lows. What is that doing? It's moving lower. So price action's moving lower. EMAs say to be long biased because the 800 EMA is down here, 200 is above that, 50 is above that. So you have indecision between price action and the EMAs, and the market sentiment line lines up with the price action movement. So to me, this is indecisive. This is very much almost in reset. When you have this swapping market sentiment and it's trading very tight in the Asian range, to me, there's no trend here. Look at it. From Friday, sideways. There's no movement here. None. Versus, if you were to look back earlier in the week, look at the movement here. Look at that clean trend on Thursday. Look at the market sentiment line on Thursday. See how it's holding above the 50 value and not going overbought all day? That's clean trend. You can be buying that in the Asian session, buying it at the start of the London, depending on how you trade, where your triggers are. You could even be buying it later in the day here after it looks like some news shook this thing up. But either way, that market sentiment line with those EMAs, with that price structure, higher highs, higher lows, everything is screaming the long bias. That's the pair that I would rather be focused on comparative to today. If that makes sense to everybody so far, give me a thumbs up so I know you're following me. Let me see, we have some questions here. When measuring risk reward to high a day, and let's say you want 2R but only get 1.5R off the candle formation, would you wait for a mini pullback and lower your entry, or is that off edge? No, that's a good way to do it, Josh. That's what James has been doing a lot. I've done that many times too. So let's say I have a markup of this. We can dig that out if you'd like. I can send it to you. But basically what you would be doing is you'd be trading the 2 candle formation, right? And on the pullback, on the 1 minute, you could trade it like a D1. And often you'll find divergence at the bottom of that 2 candle formation that feeds the bias. So it's almost like trading a D1. And you're waiting for that 1 minute 50 EMA pullback. And then I would use the same stop loss from the 2 candle formation. I would keep it original like that. Does that make sense, Josh?